All right, welcome to Talk Tickers. Sometimes the market just doesn't make sense. And we've got a perfect example of that today with Adamas Trust. We're going to dig into their latest earnings report because on the surface, everything looked great, but the stock took a nosedive. So the big question is, what happened? Let's break it down. Okay, so let's start with the good news, the stuff that should have sent the stock flying. The company, which was actually called New York Mortgage Trust at the time, absolutely crushed its earnings estimates. We're talking a solid 10% beat. That's a big deal. And you know what? It wasn't some fluke. On top of that earnings beat, they also easily covered their dividend. And get this, it's the 7th quarter in a row they've done it. I mean, that's the kind of reliable performance that investors are supposed to cheer for, right? But that's not what happened. Not even close. Despite all this fantastic news, the beat, the dividend coverage, the market just hated it. The stock got hammered, dropping over 6%. And it wasn't a quiet drop either. Trading volume was way up. So here's our puzzle. What on earth did the market see that was so bad it completely ignored all the good news? That's what we're here to figure out. Let's dig in. All right, first up, the strong earnings beat. Let's look at the numbers management was so excited about. So to really get what management was so happy about, you got to know one key acronym, EAD. That stands for Earnings Available for Distribution. For a company like this, a mortgage REIT, EAD is basically the whole ballgame. Think of it as the real, spendable cash the company made, the money it can actually use to pay you, the shareholder, a dividend. And for Q2, that number was a solid 22 cents per share. This was the big headline figure, the one that blew past what all the analysts were expecting. And this is where you can see the whole good news story in one simple chart. You've got the EAD at 22 cents. The dividend they had to pay was 20 cents. And what did the analysts think they'd make? Also 20 cents. So they didn't just beat expectations, they also had a nice little cushion on top of the dividend payment. From an income standpoint, this looks fantastic. But great earnings weren't the only thing going on. The company was also in the middle of a huge strategic shift, basically remaking the whole business. And their plan was pretty straightforward, really a 3-step process. Step 1, sell off the old stuff, their legacy assets. Step 2, buy something new, a growth engine. In this case, it was a company called Constructive Loans that makes what are called business purpose loans, or BPLs. And finally, step 3, take all that money and pour it back into their new focus areas, those BPLs and some safer government-backed securities. The CEO himself called this a pivotal milestone, and you can see why. This wasn't just some small tweak. This was a big, bold move to get their hands on a brand new pipeline of loans they could control, something they believe will start pumping up their earnings right away. Okay, so let's recap. We've got strong earnings, a safe dividend, and a really bold strategic move for the future. So why the drop? This is where we have to peel back a layer and look at what was really worrying investors. And this right here, this is the core of the problem. You had two completely different stories being told. Management was talking all about income, growth, and the future. But the market? The market was laser focused on the here and now of the balance sheet. They were worried about the company's actual net worth, how much debt it had, and just general risks in the whole sector. And this is the number that sent a chill down the market's spine, a drop of 1.6% in their adjusted book value per share. Now, even though they were making great cash earnings, the actual on-paper value of their assets was shrinking. And for a business like this, book value is king. When it goes down, investors start to think the company itself is just worth less. And the worries didn't stop there. On top of the shrinking book value, their debt levels, what we call recourse leverage, went up. Not great. Then, management even admitted that their shiny new growth area, the BPL market, was getting super competitive. That could mean smaller profits down the road. You throw in all the general anxiety about interest rates, and suddenly you've got a perfect storm of investor concern. So now you see the conflict, right? It's a battle between the income story and the book value story. This sets up a lot of tension for what happens next. So what should we all be watching? Keep your eyes on a couple of key dates. First, that corporate rebrand to Adamas Trust officially happens on September 2nd. That's them trying to signal a fresh start. But the big one, the real test, will be the Q3 earnings call in October.
That's our first chance to see if this big acquisition is actually paying off.
So when that report comes out, here's what everyone's going to be looking for. First, that big EAD versus book value battle. Can they keep the earnings high and stop the book value from shrinking? Second, leverage. Is that debt number going up or down? Third, how's that new acquisition, Constructive Loans, actually doing? We need to see real numbers. And finally, what's management going to say about all that competition?
All right, with all that in mind, it's time for the next call. Here's our prediction for what's coming up for Adamas Trust.
Okay, here it is. We think their EAD per share is going to stay pretty strong, probably in that 21 to 23 cent range. The new acquisition should definitely help keep it above the dividend. But, and this is a big but, we think the stock price is going to be all over the place, likely just moving sideways. Why? Because the market just isn't buying the EAD story right now. It's obsessed with book value. Until that stabilizes, the stock's going to have a tough time. That's why we're giving it a market perform rating. The income is solid, but the balance sheet pressure is just too big a headwind to ignore. And that really leaves us with the million-dollar question, doesn't it? Management is betting the farm on this pivot to steady, recurring earnings. But the market is obsessed with the here and now value of the company's assets. So which story wins out? That's what's going to decide where this stock goes next.
This is not financial advice.